All right, we'll start this session. My name's Adrian Roberts on the Welfare Working Group, and part of one of the questions that are coming up in terms of the welfare, potential welfare reform is funding of welfare. And we've been asked to try and find ideas about how we can fund welfare going forward, and some of the questions that we've been asking the groups that we've been meeting is whether they think that we're doing a fair thing by taxpayers at the moment, and are there things that can be learned from the insurance industry or the ACC in terms of managing government's cost and paying for welfare. So, that being the topic, our first speaker this afternoon is the Director of Martin Jenkins and Associates, a New Zealand-based management consulting firm, specialising in public policy and employing 25 consultants. He has specialist skills and knowledge in the public policy management, regulatory policy reform, organisation capability building. Michael has managed major policy reviews and forms with particular experience in the areas of regulatory policy and the use of economic tools. And from recent work with the Minister of Finance, Department of Labour and the ACC Stocktake Group, Michael has a deep knowledge of the ACC scheme and a good current understanding of the issues and challenges facing the scheme. Prior to joining Martin Jenkins in '99, Michael managed and led work for the Department of Labour, where he advised the government on introduction of competition to the ACC. Michael has also held positions with the Department of Prime Minister and Cabinet, where among other responsibilities he advised the Prime Minister on matters relating to health, social welfare and ACC. So please join with me in welcoming Michael Mills.
Just wanted to start with this quote which comes from Ministry of Social Development's briefing to the incoming government in 2008. Why I wanted to start with this quote was I sort of thought it was quite relevant to this session. Most people basically go about their lives with limited need for government intervention, but some people find themselves down on their luck at some stage, and at that point they need some help to get back on their feet. What that quote implies to me is basically, looking forward, there is some risk and uncertainty associated with our lives, and the question is how we best manage that. Second thing I just want to drop on the table on the front end of this presentation is essentially outcomes at the end of the day matter. Governments basically intervene to achieve things, and if we're looking at injury, if we're looking at sickness, we're looking at unemployment, from a public policy point of view there's big costs associated with those things. The costs relate to investments we might put in injury prevention or mitigating the likelihood of an event coming, and if that money's targeted poorly or spent on things that aren't effective, it's basically money, resource that can't be used to do something else. Lost productivity, and that's, in terms of ACC, that's a really, really, really big number. Productivity, production disturbance in the workforce, around about $600 million a year. Lost human productive capacity from people essentially have been trained, learnt skills, taken out of the workforce, around $3.1 billion. These are big, big numbers, and why, at the end of the day, government needs to be interested in this stuff. Cost of direct provision around health rehabilitation, maybe $600–700 million. Administering the stuff, $55 million. Dead weight costs, government transfers. In fact, the money could have been used for something else, $230 million. And then, from a claimant point of view, pain and suffering, and depending on how you calculate or quantify that, $16 billion. Really, really big numbers. And what government, from a public policy point of view, wants to do is to reduce those costs, and the question is how best to do that. Insurance, just a bit of basic information. What it is basically a contract and agreement between one party and another party, where in return for a premium which is paid, the insurer basically has certain obligations if particular future events occur. It's as simple as that. what it's about is risk and its management, and essentially it's about the transfer of risk from one party, the insured, to another party, the insurer. So it's a mechanism for managing risk or uncertainty, such as future impact of injury, illness, unemployment. What the insurer does is it actuarially assesses the likelihood of that risk occurring. It basically quantifies that risk, and in return for the transfer, it charges a premium on the front end. The insurer basically will then invest that premium and use the income and that capital to pay out the future cost of the claim. That's really, really important. If the risk does eventuate, then the insurer is basically obliged to provide the agreed benefits. So that's sort of 101 insurance. And I sort of make the point that insurance, like welfare, is basically a mechanism to manage or spread risk. Basically, welfare spreads it across the whole community, and then the taxpayer, as the particular event, risk and the costs occur, pays for it out from taxes. Insurance, I'd say, is different. There's a contractual relationship, so there's a direct relationship between the parties, and that is important. There's a premium paid in advance of receiving the cover, regardless of whether or not the event occurs. Insurers basically have to manage that premium, those reserves. They've got various techniques for doing it. They invest them, sometimes they'll reinsure, sometimes they securitise, and then they can actively basically manage the risk itself or the consequences of the risk.